So what is asset level lease accounting? So asset level lease accounting, you can see there on the right of the screen, is when you're generating debits and credits for each lease asset, right? And that's contrasted with contract level lease accounting, in which the debits and credits or journal entries are generated at the contract level. Now, if you look at kind of the market of software providers out there, most of the providers came from the real estate world, where traditionally for real estate administration purposes, there was kind of a one-to-one relationship between leases and buildings or leases and land. Whereas in the equipment leasing side, we've had to deal with individual leased assets for many years, and so there's really kind of two fundamentally different architectures at play. So as the new standards emerged, both real estate companies, real estate administration companies, and equipment lease management companies have added lease accounting capabilities, and they have either one of these two approaches, one of these two models, contract level or asset level lease accounting. So if you do asset level lease accounting, that means you're generating debits and credits for each asset. In order to get to the contract level, you simply aggregate those journal entries on a monthly basis to produce the contract level accounting, and then further you can aggregate that to get the portfolio level accounting. By contrast, the contract level lease accounting can actually do the asset level lease accounting. So what they do is they have a table that they've created where they'll put the asset level cost information, and they'll simply allocate the contract level rent to the assets proportional to the cost to get an asset level rent, right? And so they get that breakdown, but they're not actually generating debits and credits. And we're going to explain to you why the difference is relevant, how it's relevant in the context of the new standard. So if you have asset level lease accounting, there's this kind of basic concept that you can treat every asset like its own lease. And here's a couple examples about why that's important in the new standard. So under 842 and IFRS 16, they want you to determine the life of the asset represented in the term of the asset based upon your reasonable economic certainty of holding the asset. Now, in this example, there's 5 forklifts on one lease, and those forklifts are distributed over 2 locations, Fort Worth and Arlington, Texas in this case. And because of the holding pattern, maybe the environmental conditions, the usage pattern at Fort Worth, they know that they have reasonable economic certainty that they're going to renew at the end of the initial term, which is 48 months. Most equipment leases, you typically come with 1 year or 2 year or some other renewal term. In Arlington, they just have a different hold pattern, right? Maybe they don't use them quite as much. And so they know that they have reasonable economic certainty that they're going to keep them not just for the initial term, but for an additional year. So in this example, even though they expect to return the assets at the end of that term for each asset, you have 5 different assets with different lives and fundamentally different amortization schedules for each asset, right? So fast forward to the end of term. And in this scenario, one of the assets moved from Fort Worth to Arlington. So what happens in that scenario, in this midterm event, right, a location change? Does it pick up the 60-month term midstream, which would require that you re-amortize that asset, right? You can only really do this if you have this basic concept of every asset as a lease. This is an uncommon scenario with assets. They move around all the time, right? Equipment, that is, certainly not buildings or land, but certainly equipment. You know, another view in terms of the end of term are partial events, which are also very common. There's typically in equipment leasing 4 options at the end of term. You can renew, you can return, or you can buy out. And the 4th one is evergreen. You can just forget about it, and the invoices will keep coming, and you keep paying it, and you still get to use the asset. But as fleets age, the break-fix costs go up, and the kind of hidden costs are the labor. And that's true whether you lease it or you buy it, right? So companies want fiduciaries for management of assets, they want to be able to replenish their assets and keep them productive and profitable, right, contributing to the business. So, but most companies just struggle, whether purchased or leased, to return stuff on time. And so evergreen is quite common. But when you have a lease that has multiple assets, and you have at the end of term partial events where you're returning some and you're buying some out, and you're renewing some and maybe some are evergreen, those can all have very different debits and credits at the asset level, right? If your platform, if you don't have the capability to generate the debits and credits at the asset level, that means you have to pull the data out, maybe into a spreadsheet, figure it out, and put it back in, which is not really practical, especially this stuff's going to be on balance sheet. And when capitalized, it's going to be far more audit scrutiny. And so this stuff should just be automated, and it should be rather straightforward, right? So this is why asset level lease accounting is in many ways required by the new standard. Standard setters kind of identified this as their kind of basic unit of measure, right? So this is another example of asset level lease accounting. In this example, we're going to talk about nested components, midterm events, and allocations. So you have 5 supercomputers, and within those supercomputers, you can have many different components, each of those components having their own serial number, right? Servers, routers, firewalls, power supply, and those assets are controlled by different owners in the company, right? Pretty common scenario, right? We call these super assets in some cases. In this example, the company needs to upgrade the power supply. So pursuant to the mechanics of the lease, they return one power supply, lessor accepts it, and then they get another more powerful power supply put into the system, and the lessor, along with that, issues a new coterminous lease, right? So now you have these 5 supercomputers, all these different components. You've done an upgrade, right, to a component, which is also serial numbered. This is a little bit less common than the location change, but it also happens, right? And your software needs to be able to support that in order to do the accounting. Otherwise, it creates far more complexity, right? Another dimension of this is cost allocation. These assets, these super assets, are shared across the company, and they need to be the allocation needs to be split across multiple cost centers, right? In this case, financial analysis gets a portion, ERP gets a portion, right? That's also very common. We know of another example of forklifts. There's different cost centers in a giant plant manufacturing process. There's different cost centers in the front of the warehouse, the middle of the warehouse, and the back of the warehouse. As it goes from one part to the other, it using RFID, it tracks it, needs to be allocated different cost centers, right? Okay, the software has to be able to do that, and the only way it can do that is if it truly is able to generate the debits and credits at the asset level, and is also kind of connected to the company's internal GL string, corporate hierarchy, and kind of cost center organization for each ERP platform, which we'll talk about a little bit more later.